Hey everyone, good morning. Okay, it's not Mr. Chandra, it's Miss Chandra, so I'll just clarify that right at the beginning. But great to be here in New Delhi, and we have a cracker of a panel here. Very good composition, two founders of profitable startups, profitable unicorns, and of course we have the investor representation as well. Alok and I were just talking before the session on, how many startups, how many unicorns are profitable. While it is a minuscule fraction today, the good news is we have two profitable founders on stage who will tell us about what it takes to chart that path to profitability. And also if profitability is a temporary focus now in the current environment or if it's here to stay. So let me actually start with Vikram. Vikram, if you can give us a perspective, everybody is talking about a funding winter, a funding crunch, and suddenly profitability has become, the in thing. It's a good thing to talk about. So is it a temporary shift in mindset or is it here to stay?
So I think, this whole perception of the profitability becoming in thing now, I think I would slightly disagree with that, especially from an investor's perspective. Profitability is important right from day one. It's just that the startup is not profitable at that time. That's understandable because initially you're focusing on acquiring a market, building a top line. The market size is so large, you want to make sure that before anybody else enters that market, you actually go and acquire a large part of the market, and all that requires investments. And therefore, you build capacities towards the future, and you will be making losses in the beginning. But what is important is profitability and the profitability mindset, which means your business has to be such that your gross margins of the business are high, and then the capital efficiency mindset attached to that, which is very important, that you're actually using the right set of resources. The productivity of the resources is good. You're going after the right markets and not burning just to do too many tests. Of course, you should be taking risks initially to do certain tests, but you're not taking undesired tests or risks which are not required at that stage of the business. So I think if you're making losses in the beginning of the business where you are still, capturing some market, it's very natural that you'll be making EBITDA losses. But eventually, profitability mindset is very, very important, and that's the reason, when you're profitable at scale, that's the time when you really see the proof of the pudding,
but
that you're actually getting value.
In case the funding environment changes, will we again see this growth at all costs mindset coming back?
I think there is definitely a huge, I would say, you've seen a shift of mindset, and it gets driven by the amount of capital available in the markets, right? So if you look at 2021, we were talking about COVID led to a lot of money getting printed and getting distributed to people, and that money coming back in form of investments, and therefore there was more capital available than the demand for capital. So there was naturally, the valuations went up very high. People didn't look too much about the immediate profitability, etc. at that time. As soon as the gears shifted in 2022, so obviously people started questioning those very decisions. And now that we're in 2023, I think, and we have this history and experience of this entire cycle which has happened, now people have gone back to fundamentals of understanding the basics of the business and does it really make sense to really be in a business that they're investing in. And there have been corrections in valuations for the right reasons. We're looking at some data, even from the US context. If you look at the IPO pricing versus the current market caps, the companies are almost at 30% of their IPO pricing, except for a few companies like Airbnb, which was $86 billion at IPO and $74 billion even today. You will look at companies like DoorDash, which are $60 billion at IPO and $20 billion market cap today. So average, you will see about 30% of their IPO pricing, which is now the valuations there.
Right.
So that correction had to happen. So I think, which is good for the ecosystem.
Right. Alok and Ruchi, both of you run profitable firms, and cash flow positive firms is not adjusted EBITDA or whatever new age firms like to call it. I just want to understand, is profitability something that a founder thinks about on day zero? Should they think about profitability on day zero? Should they think about it a year after starting up, 2 years after starting up? How do you sort of build the profitability mindset? Because you can't just wake up one fine day and decide. So what goes into it, and how did you, both of you think about it?
You want to go first?
So I think I'll agree with what our co-panelist actually brought out. So each stream, every founder starts by thinking how they can create value rather than day one thinking about valuation. Now, there could be different businesses which would have a very different story of how to create value, right? Most of us sitting here order differently today, go from one place to the other differently, right? Have a very different way. Most of us have ordered online for most of the dresses we are wearing as well, right? So the way India was 10 years back or 5 years back is different in terms of how we actually do business, how we actually live our individual personal lives. And many of the startups are part of this journey. And that is a bit of the value creation story. Now, in terms of building an enterprise, sometimes it requires huge investments. But as a founder, the thought is always that what is the value creation story for the entity? For us, yes, from day one, we wanted to be profitable because, first of all, the space that we are in, B2B, it is something which has to become profitable because it's not that you need to spend a lot of money in acquiring customers. So if we end up spending too much money in acquiring customers to reach our end goal of a revenue number, then we are going wrong in how to create value. However, there are a lot of businesses wherein an initial marketing spend is required, initial framework is required, where you need to do that investment. And hence, yes, that will lead to profitability, but you need to create that base and a structure. It's like building a house, right? Sometimes you build a house and you can put the first floor on rent and keep building the second and the third floors. But sometimes you have to build the full building and then only you can sell it, right? So you need to make an initial investment. For us, because we were in B2B, as well as lending as a business, it's very, very clear in every investor's mind that it needs to make money. You cannot be net worth eroding. So there are businesses which can, if they are in the right spirit, if they're built with the right thought process and inputs, can reach profitability much faster. But on the other hand, there are businesses which actually will take time to reach that profitability, but to build that scale, we need that investment. But to use the second logic to build the first business type, or to use the second logic that it will come, but having no sight of profitability is wrong. So the third option of having a reason for spending money without seeing how it will generate value is something that all of us should avoid.
Right. Very interesting points. And, Ruchi also gave a very granular view of profitability, that perhaps B2B, lending, those segments lend themselves to profitability more than consumer-facing businesses where you have to keep spending to acquire customers. And that's a pattern that we've seen in e-commerce, in edtech, in payments, and so on. So Alok, again, do we have to look at this, in a more subjective way? Can there be one playbook for profitability? How founders look at it? Take us through your own experience.
Yeah, so I think in our journey, we were very lucky in the first few years to not get the money easily, right? The first 5 years,
People like Vikram are not helping you.
Well, we tried. But the first 5 years, and ixigo was not the first online travel company in India, right? We already had well-funded incumbents, OTAs, etc. in this space. For the first 5 years, we couldn't raise a Series A, right? In hindsight, that's what built our DNA and muscle. So I think fundamentally profitability and the inclination of thinking in a frugal manner is something that becomes the company DNA. And more important than tough times, it's during the good times how you behave that defines whether that DNA gets built over time. Everybody says, yeah, times are tough, we move towards profitability. But when you raise your next round, are you again going to start spending on things that make zero sense, right? That's when the decision is much harder because the temptation is to go and spend on those things to just show growth. But I think the fact is if you're not building a company for investors and you're building it for creating some real value, solving a real customer problem, I think what really matters is what is the burn going to fund, right? Is the burn going to fund growth at all costs without a product market fit? Or is it going to create capacity so that you say that when I reach a certain scale, I can be profitable and it's within my control to actually burn only this much to reach there? And I'll give you a small example. Like we raised our round in 2011, the first round, started spending, started trying many things. And soon we realized that, whatever we were spending on some of the paid marketing channels made zero sense. And even though we tried everything, we realized that, look, a lot of these guys just come because you're spending money or you have a discount. And, at the end, the moment you stop doing that, you don't see any retention on some of those channels. And then you realize that you have to go back to the basics of how you operated when you had zero capital, right? So whether it was doubling down on viral video marketing, whether it was, just not adding too many people in the team. We were actually just 100 people for the first 10 years. We didn't cross 100 people in our business, right? And I think forcing that upon yourself and making sacrifices during the tough times, I think as a founder, stepping up and being the first person to say that, look, founders and leadership go down to zero salary. If we have to save the company, we have to do certain things. And those things, build a different mindset among the rest of the team and brings in the resilience required to carry through the tough times. But when the times are good, that's when you got to put the brakes on, not spending mindfully, right? And because I know that the times will be good again, right? I've seen enough cycles to know this cycle won't last forever. And it's during those times that the DNA will get built. Right now, it's very easy to say, yes, I'm going towards profitability and I'll show it in 3-4 quarters. What do you do when you get your next round? That's what defines it.
But where does that discipline come from to not overindulge during the good times?
No, I think very valid point made, and I could relate it to our journey as well. I think when you have limited capital, then your mindset becomes the same in terms of how do you create value out of that limited capital. And you try to, cut small costs here and there, and that it's a matter of DNA. And if that DNA is inculcated upfront, because it's the initial team of 20, 30, 40 people together actually has seen those times, whether it was for us and ILFS or COVID, and through those periods, if you know what's the right thing to do, then that DNA becomes a part of the DNA of the organization, because the DNA of the organization is defined by how, like, the top 25 people are operating in day to day. Like, for example, if I'm asking the same question, people who are working with me are asking the same question, ki bhai, margin kam kyun hai? Or the same question, okay, if you net off the operating costs, you'll not, as a business unit, make money. So those conversations become a part of how you are having your daily conversation. It's not like a one-time investor conversation. So that's what defines decision-making on a daily basis. So yes, I think a little bit of conserving capital. And for us, the second thing that worked was we always looked at equity as a source of capital. For us, debt was also equally an important source of capital. So you try to build your outcomes or business outcomes in a way that you can attract different types of capital, and that automatically makes you, for example, at our time, a bank would say, I need 3 years financials in green. That became 2 years, right? That was at least a time like 6 years back. And then you're like, okay, if I need to tap debt markets, then this is what are the ratios that people will look for. And hence, those become your business outcomes. So I think a combination of the fact that as you grow, you will need different types of capital. Like, for example, we would have 50 lenders on our balance sheet today, right? So that also inculcates discipline. One is more internal, as to what our friend mentioned in terms of saying that how do you build the DNA. Second is which parts of the external market did you pick up and say that defines the outcomes. I think the question was, will you push for growth and all? There'll be investors saying something, there'll be lenders saying something, there'll be consumers saying something. Which parts of you pick that up and say that this should define what your DNA is?
Right. Rohit, would you want to add to that?
I think, I hope everybody is able to hear me. Yeah. So I think very good points which have been put up, Chandra, by all my fellow panelists, starting with Vikram, Aloke, and then Ruchi. I'm very glad this conversation is happening because, see, I can bring a perspective from the public markets point of view. See, and in public markets, there's something we call as a holy grail, which is return on equity. Right? Public markets reward such companies which demonstrate consistently growing their business at very high ROE, return on equity, which is more than 20%. And on the contrary, there are businesses which go out and do buybacks, which they further improve their return on equity. Markets even reward them more. And on the other side, businesses which very frequently visit the markets to raise more capital, public markets punish them. I'm constantly qualifying public markets because private market investors' behavior could be different than public market. So at the end of the day, wealth creation is all about, making money on money. So, if let us say you've created a market cap of, let us say, 1 billion, and you've raised a capital of 1 billion, that's one thing. And there is another business which has built a market cap, which is a valuation of 1 billion, and they've raised 100 million. It's a different business altogether. So I think at the end of the day, whether it's a unlisted business or a listed business, the holy grail remains return on equity, and there are brilliant examples on both sides of the game.
Yeah.
On one side, as Mr. Kant mentioned about Zerodha, it's a great example. Hugely profitable, growing at a very healthy rate. Similarly, on the public markets, a company called Asian Paints. And it's also industry agnostic. If you look at, we said about tech companies and all, you look at the US, the FANG companies, the good old, they're still the FANG companies. They are hugely profitable. All of them are hugely profitable. And perhaps because of them, 3-4 of them are also sponsors that are sitting at the top. And it's all coming because they are profitable. And if you look at their stock market performance also, in a year like 2022, which was the most difficult year for the US stock market, we are in India, we don't realize it, where the NASDAQ lost almost 30-40%. Apple is positive at 2%. And Microsoft has just fallen in calendar year 22, just 5%. So at the end of the day, the return on equity is a holy grail. Profitability is a holy grail. Whether you are an unlisted business, you are a listed business, whether you are a technology industry, non-technology, anything. So I think that the rules of the game don't change for anybody.
Right. Since you mentioned Zerodha, I should ask you this, Aloke. We were just crunching data on profitable unicorns. It just so happens that 23 out of 100 unicorns are profitable. And the top 3 most profitable unicorns are bootstrapped. So there is Zoho, there is Zerodha, and then there is Mu Sigma, which bought back its investors. So is there a direct correlation between profitability and the lack of VC money and investors? Does that spoil discipline?
I think easy access to capital definitely impacts discipline. I mean, we've had our own examples as and when we faced tough times, the inclination to go back and fix the basics and make the business grow organically without needing fresh capital, that's always there for every founder, right? And I think for these 3 companies that you named, I do believe that it's very tough to imagine building a business without having access to outside capital for so many years and yet reaching an outcome where, the profitability is in triple-digit, quadruple-digit crores, right? And I think for certain consumer internet businesses where the nature of the market is such where a certain amount of money is required just for capacity creation. If you look at e-commerce, right, you need logistics, warehouses and all that. There is a certain capital requirement. Most internet businesses will have a certain amount of capital requirement. I think it's just hard to imagine how those businesses can get built without any outside capital of any sorts, unless the founders themselves have deep pockets. But I think it's more to do with the discipline that the board and the investors also want to see in these companies. I think we were living in an environment where the VCs were also okay with how things were going, as long as the next round was within sight and the next round was a markup, right? And I think it just creates bad incentives for all the actors, right? Because you're chasing valuation instead of value creation, right? As a founder or as an investor, that makes zero sense. Because valuation should follow from value creation and not vice versa. So I think it's important to remember what the goal post is. If the goal post is only about raising the next round, the incentive alignment may not be towards profitability, it might be towards growing at all costs, right? Whereas the goal post is around creating a sustainable business. You're okay with lower growth so long as you are actually fixing the basics in the business. So I think it's important to set the right incentives.
Right. Vikram, I'm going to ask you to respond to that. Are VCs hung up more on valuation than value creation? Are they okay as long as, the next round is a markup? And secondly, do you think, VCs need to be more consistent when it comes to what they expect from their portfolio? Because before, this so-called funding winter, there was a pressure to grow, show those numbers. And then at the first sign of trouble, cut your burn, show profitability. So it also brings a lot of pressure on the founders to change that slate overnight. So, these 2 points, if you can weigh in.
So, one needs to understand how the VC model works, to understand that, right? So if I'm a venture capital investor, I've taken somebody else's money. I have promised to that investor that within a time frame, I'm going to return that money. Typically 5 to 6 years is the horizon I look at. And in that time frame, if I'm investing in 20 companies, in every company I'm expecting, let's say I'm going to get a 10x because I'm actually looking for that kind of an exit. There will be failures, so which means some of those companies have to give me much more than 10x, and others, maybe 10%, 20% of those could become zero. So in that situation, right, so the VCs tend to look at the businesses which are disruptive in nature. And when the businesses are disruptive in nature, the potential for scale can be exponential, right? So you can actually see exponential growth. Now, if you look at a model like a ChatGPT, for example, if you had the opportunity to invest in ChatGPT today, zero revenue, but is there profit today? Absolutely not. But look at the disruption. If you had an opportunity to invest in that as a VC, you would absolutely want to invest in that, because you don't even know, where the revenues are going to be. In fact, the CEO of ChatGPT was asked a question, what is the valuation? He said, we'll ask ChatGPT themselves. So they will answer the question. But the point is that I think from a venture capital perspective, disruption is the key. Disruption brings the potential for exponential growth. Each business that you're investing in, you're looking at 5 to 6 year time frame. You're expecting, a substantial value increase happening, and you will have failures, but the ones you succeed in will succeed really well. At IvyCap, we've actually been very, very focused on profitability mindset right from the beginning. That's very important for us because we believe that at the time of exit, when we are looking for a 5 to 6 year exit time frame, either the company should be already profitable, if it was not profitable at the time when we invested, or it should have shown the signs to be profitable very soon. At least, from a margins perspective, it's a very good story to tell. So that's the kind of thing we need to build, and that's why we keep pushing the founders to achieve what they're out to achieve from the business perspective. So that's how, VCs would typically look at things.
Got it. Rohit, you mentioned how expectations from the public market are starkly different from the private market. And we've seen this play out, when it comes to some of these new age tech company IPOs. All of them are talking about profitability now. But one metric that they keep using is adjusted EBITDA. And there is no standard definition for what is adjusted EBITDA. Everyone adjusts it the way they want to. Do we have to rethink or junk this adjusted EBITDA, go for good old EBITDA? How do you look at it?
Go for cash flow.
No, I think very, very interesting. And I would say very important question, Chandra, and thank you for asking it. So first of all, I would say whether it's adjusted EBITDA or EBITDA, good thing is that companies are talking about EBITDA. So let it be adjusted EBITDA. At least they're talking, EBITDA is coming into that. But my personal opinion on that is that there's nothing adjusted. There's only one thing which is reality in life. I think those are only creative accounting practices. Reality is profit is profit. Either you have profit or you don't have profit. So I think it will be sooner than better that the reality sinks in. These are very, very brilliant founders, brilliant entrepreneurs. I think their potential is far more. And they're just kind of getting distracted by these small, small little things. They can create very large businesses. They've already created very large businesses. They have to do it. They have to think profitability, convert them into a cash generating machine and make them possibly the Apples or the Googles of India.
Right. Ruchi and Alok, both of you run, businesses that have reached significant scale today, and I'm sure you're thinking about an IPO at some point. So what are the one or two things that you want to keep in mind, or, the lessons from the 6, 7 IPOs that we have seen in the last couple of years? Keep in mind when you are ready to hit the Lal Street.
For us, an important thing is we have to continue doing what we are doing. I think that's more important. I heard the word distraction. One should not get distracted, because as a founder from day one, you define some key principles on which you're building the business, right? And for us, those 5, 6 principles are very, very crucial, critical, and they still stand. Like, for example, for us, that we will always be net worth accruing, for the fact that we will always take debt and equity together, for us that technology is an enabler for us as we build the business, or for that matter, in terms of saying, are we sales first or marketing first? So there were some principles that we had defined, right? If we continue on those principles, for us, public markets is a new capital source, is a different capital source. For us, we've thought about each capital source in a way that it should be respected. I know a lot is said about investors in terms of how can they give these crazy valuations. But at the end of the day, we have a lot of respect for all investors who rejected us, as well as all investors who came on our cap table, right? Similarly, we have a lot of respect for each of the lenders who's on our balance sheet, whether it's a 5 crore lender, 50 crore, or a 300 crore lender. And I think if we show the same respect for each individual who actually comes and actually invests in the IPO, and showing that respect means that we prepare for it well. We go IPO at the time we think we can deliver as per their expectation. That's for us showing respect. In terms of what they want, whether it's an EBITDA multiple, PAT multiple, or whatever it is, when we think that we are ready to show that respect so that we can actually justify why they're putting up money in that company, I think that's when we'll go IPO.
Got it. Alok, you want to add?
Yeah, I just want to add, based on our interactions with public market investors, what we've understood is that these folks value things like governance, predictability of earnings, and operating leverage. Because internet companies, by definition, you should have operating leverage, right? Like, your margin should improve year on year. And I think for us, the big parameter is that, as we grow, as we become more and more profitable, I think it's important to not let the hubris get to our head. We're still a very small company with very small earnings, and there is still a lot to do to earn more trust among our customer base. So I think that's one, and also just to under-promise and over-deliver, that's something all my mentors also tell me, that, look, it's very important to not make tall promises which you cannot keep. It's better to say you'll grow X% and then deliver more than that. So I think that's very important.
That's a classic Infosys approach. Yeah. We keep talking about unicorns, and that's sort of the desired end state for many startups. But both of you have interesting monikers for startups. I remember Vikram often talks about dragons, and Aloke talks about cockroaches. So do you want to tell us about that? We should stop thinking in terms of unicorns. We should think about other creatures. So tell us about dragons and cockroaches.
I think globally people have been celebrating the term unicorn, which is $1 billion valuation. And we all know that, $1 billion valuation is a valuation at one point of time, and that can go up and down. You can be unicorn today, you may not be unicorn tomorrow. So in our focus, we look at IvyCap is dragons. What do we mean by dragons? A dragon is a company in your portfolio which gives you more than 1x cash returns on your entire fund. So what does this mean? So we had the first fund, 240 crores. We had one company, Purple, where we had put 15 crores for a 30% stake. We exited that, at 330 crores in one single exit, right? So which actually gave us a dragon exit. So our focus is to actually really create such dragons. And I think that's also in a way looking from a profitability mindset perspective, because eventually we are answerable to our investors. They're also looking for profitability, and we are looking at the portfolio level and trying to create as many dragons as possible in the portfolio.
So good luck with all the dragons. Alok, why Cockroach?
Well, I think if you look at cockroaches, right, like
They can survive a nuclear...
Yeah, basically, look, they're operating under the radar. You can't see them, and they know how to survive in really bad times. And once in a while, they can even fly if they want to. But I think the important thing there is just the resilience that that creature has, right? Like surviving through the toughest of times, if you're able to just keep your head down and keep doing what you're doing. And I think we've been through that not once or twice, but like multiple times where, we didn't know how to pay the salaries for the next month. But being able to figure out a path around that, as a founder, as a team, because the team is obviously also willing to sacrifice during those times and help you get out of it. I think those are times that create cockroaches. And why I love this term is that, I think there has been too much attention about, valuation-led terms have an issue that, some of those unicorns may not be unicorns today, right? Because ultimately the definition is related to a valuation. But I think what I like about Dragon and, both Cockroach is that, end of the day, the aspiration is to create something which is more long-lasting, right? I mean, the companies that actually return these funds are companies that created enough value for someone to come and give cash worth that. And that should be the benchmark, I think, that how much cash have you been able to return your investors? I mean, I can tell you proudly that on average for our past investors, we've returned 6 to 8 times of the capital they've invested till date, right? For the ones who've exited. And I think those are the metrics that mean more to me, that we've been able to earn the trust and deliver that as opposed to any valuation we achieve.
Great. We have, I think, 7 minutes. Closing thoughts from all of you. Ruchi, anything that you want to leave founders with when it comes to profitability, a playbook perhaps, lessons that will serve them well in good times and bad times?
So a couple of things that come to my mind. First is it's great to actually have this discussion. I remember a board conversation really long back, 4-5 years back, and there used to be always this tussle between growth versus ROI, and in terms of ROA, in terms of what is the return on assets and what's the ROCE is what we just generally track, right? And I think the balance is important. It is not that just because you have to, cut short your journey to profitability means that you have to massively compromise on growth, right? Both the things have to go through a balance. But at the same time, if you don't have line of sight to profitability and it's just a wish or a hope, then it's something that you as a founder should answer upfront as to what is the kind of enterprise that you want to build. Because for us, an enterprise is worth even being called a unicorn or something that outlasts us as founders, right? So that's our philosophy. Will your institution outlast you as an individual? So if you think of it that way, then you need to have that resilience to go through various cycles. Then you need to have cash that is accruing and can be invested back into the business. Because if you expand, you'll need CapEx and everything else, right? So the institution needs to outlast you. The only way the institution can outlast you is because whether you build in the mechanism that it has the resilience, it is not dependent on individuals, and the fact that it is accruing cash. To do that, I think there needs to be 2-3 different mindsets. Someone who's actually keeping a cash record, in the sense more than generating profit, it's important to also manage cash in the initial journey. So don't lose sight of cash flows. Your business starts with cash flows management. Cash is king. Second is profitability is crucial to say when you have reached a particular level, then you need to generate that cash from a business perspective. And profitability is not just about expanding margins, it's also about reducing costs. It's also about cross-selling things, it's also about finding newer opportunities. And most importantly, the thing that has worked for us is, whatever is not working, shut it down fast. You know, it's like a part of your organ which can actually spoil the full body, so hence you're okay to chop it off. And that as a founder actually helps us significantly.
Very well put, Ruchi. Rohit?
Yeah, I think my parting thought, closing thought on this discussion would be, I've thoroughly enjoyed all the thoughts together, that, profits are the benchmark, they are the foundation for growth. Because if you don't have profits, how will you fund growth? And there are companies which are profitable, but if they're not investing their profits in growth, they don't get a high multiple. So, but there are companies which invest their profits back into the growth, they get a high multiple, and there are many good examples. I've just mentioned about Zerodha and Asian Paints. They're a very good example of, Indigo. They operate in an industry which is highly competitive. Others, find it very difficult to stay profitable. They have remained profitable year in, year out, right? Which means there are two entrepreneurs or maybe half a dozen entrepreneurs in the same industry. Probably one has figured it out how to run a business profitably and also grow it. So they are leading market share with about 56% of the market share, and they're profitable. So, at the end of the day, it's...
So you don't have to sacrifice one for the
You don't have to sacrifice one. Your business model has to be good, and you have to run your business very well. You can get the market share. India is the market to build market share. We have 1.4 billion people. If you won't build market share, where will you build it? So I think that's the way to go.
It's a good one. Aloke?
Yeah, so one tip that I can give all the entrepreneurs in the room, which is very valuable, like about 4 years ago, we started this practice at ixigo. And as you scale, it becomes more difficult to do this, but we look at daily P&L. So every morning I look at the P&L of the last day to the last rupee, right? And without that, you improve what you measure, basically. We all know that, right? Like without that kind of discipline within the team, within the leadership team, it's very hard to not just achieve, but also grow profitability. And similarly for cash flows, right? Like end of the week, we look at the actual cash balances we have, and we track that every week, right? So I think just doing that one small thing changed the mindset for the whole team as to what metric are we looking at, why is it important, right? So I think that's something you can do at every scale.
That's amazing. You can improve what you measure.
Yeah, and I totally agree with whatever has been said on this. I think eventually, it's not easy to maintain that discipline. It's very, very important. And one thing which I would still like to say that, despite all this importance of being profitable, I think if you're onto something disruptive, that does require investments. But as long as your mindset is capital efficient, you're not burning cash for unreasonable purposes, etc., I think you can build something which is huge. And for building something huge, you need to invest into the business. But I think one should think of how to evolve with the cockroach mindset into a dragon. So I think eventually that
Maybe
should be the...
instead of unicorn lists, we'll start making cockroach lists and dragon lists going.
Right. So I think that's I would like to say as a...
Great. On that note, thank you all very much, Ruchi, Rohit, Alok and Vikram. A huge round of applause for all of them. Thank you very much.
Thank you so much. That was a very insightful session, and we would also like to present to you a small token of appreciation from TiE and from our gifting partners. So please stay on the stage so that we can quickly present to you a token of appreciation and also the book from Papa CJ. Can we have a big round of applause for our panel, please? That was a very insightful session on Path to Profitability. A big round of applause, please.